Hi, and welcome to the Morgans Edward Street Weekly Wrap for the week ending the 22nd of September. My name is Tristan Alhone and I'm a client advisor at Edward Street. Over the course of this update, we will be referring to particular stocks, sectors, themes and recommendations. Please be aware that our comments are general in nature and please speak to your Edward Street advisor to determine if the advice is right for your circumstances and risk tolerances. Global markets have struggled this week on the back of commodity prices falling, the chairman of the US Federal Reserve speaking yesterday morning, as well as Donald Trump's latest missive to North Korea. To tell us more about it, over to Matthew Gordon.
Thanks, Tristan. A tough week for commodities, with iron ore falling back below $70 a tonne, sending Rio, Fortescue and BHP lower as Chinese steelmakers lower demand for the steel ingredient. Gold has also lost a bit of its shine as well, with Janet Yellen signalling that the US will unwind its quantitative easing program from October. The market sees this as a likely increase in interest rates sooner than later, which has seen the bond proxies and infrastructure plays like Sydney Airports, Transurban and APA Group lower this week as a result. In company-specific news, we have seen the $11 billion merger between Tats and Tabcorp thrown out by the High Court, sending both stocks lower as a result. Telstra is also approaching its 5-year lows at $3.50, whilst investors stomach the reduction in the dividend. Commonwealth Bank has finally sold its life insurance business for $3 billion, sending shares slightly higher, and oil stocks like Santos, Oil Search and Woodside have moved stronger on the oil price. Our market had a pretty negative reaction yesterday, with the index down 70 points at one point to 56.50. As mentioned in our past weekly updates, the market continues to trade within a trading range, with the bottom being around 56.50 and it's still in place, and 5,800 points being the ceiling, which we're desperately trying to break recently. Seasonally, our market is usually trading in a weak patch between May and October, so not much longer before we enter the Christmas rally, which many of us have been waiting for. Thanks, Tristan.
Thanks, Gordo. Now over to Cameron Mole to find out what stock he likes the look of this week and why.
Yeah, thanks, Tristan. Today I'm going to speak about Domino's Pizza and why I believe it is a buy. Viewed as one of the most successful growth stories on the market, this company has continued to deliver and exceed expectations year after year under the helm of CEO Don Meij. Recently, however, the stock has had a material derating of its PE and consensus earnings rebase following a lower than expected full year result. This, in my view, has presented an opportunity for new clients to buy into the stock or for existing clients to add to positions, with Domino's now trading on 24 times FY18 with an expected EPS growth of 26%. This compares to its US parent company, which trades on 30 times PE whilst offering only 18% EPS growth. We expect the growth of Domino's to largely come from Europe as the company looks to expand its international footprint. Domino's has a number of upcoming events, including an Investor Day on October 9 and an annual general meeting in November. Whilst we don't see these catalysts as game-changing events, we believe any surprises or mention of potential acquisitions would get the market excited. New surprises and innovative thinking is something Don is renowned for, which has allowed him to build the business into a $3.9 billion company. His innovation, whether it's delivery robots, GPS technology, or the original hotbox, has resulted in the market viewing this company as a technology business and not simply just a pizza shop. We see the pullback in share price as a buying opportunity, mainly based on a more suitable valuation rather than catalyst driven. Analysts have reviewed their expectations with what seem like more achievable targets, and I'm backing Don to create wealth for his investors once again. As such, we remain happy buyers at the current price of $44, and we believe any weakness in the share price would just add to the appeal. Thanks, Tristan.
Thanks, Cameron. With footy finals around the corner, I suspect Domino's would be gearing up for a busy couple of weeks. We have a fairly full pipeline of upcoming IPOs, ranging from small growth stocks in the agricultural space up to a larger, more established industrial and construction business. Also, a recently released share purchase plan from Superloop looks interesting, so please speak to your advisor if you'd like more detail here on any of these opportunities. Well, that wraps up another edition. Please speak to your advisor about any of the stocks we have mentioned today, and we'll see you again next week. Don't forget to order a Domino's pizza and cheer the Broncos home this evening.